Jamie Dimon, the CEO of one of the largest global banks in JPMorgan, has recently issued a number of alarming warnings around the economy, including where things could be heading in the future. Dimon addressed a number of topics in his recently released annual letter to shareholders, and his outlook on the current state of the economy and what could happen in the future if things get worse are both fascinating but also very concerning. First of all, Jamie Dimon believes that the risks within the banking system that we've seen play out in recent weeks were hiding in plain sight thanks to how high interest rates have been raised to and the impact that this has had on fixed income and held-to-maturity portfolios. We've obviously seen the likes of Silicon Valley Bank and Signature Bank collapse last month, and the government was forced to step in and protect depositors beyond the usual $250,000 limit. And more recently, we've also seen the collapse of the financial giant Credit Suisse. Dimon unfortunately sees more trouble ahead within the banking sector, and the scary thing is, he doesn't think it will just be a short-term problem. Instead, we could see banks continue to fail and collapse for a number of years. In the letter, he also says the current crisis is not yet over, and even when it is behind us, there will be repercussions from it for years to come. Now, the fact that interest rates are likely to remain this high for quite a while does indeed point to more banking failures in the next year or so, as this is one of the main driving factors behind the recent banking problems that we've seen. In fact, the Fed has actually hiked rates by a further 25 basis points since the collapse of SVB and Signature Bank, despite many economists and financial organisations warning that this could be a bad idea. SVB and Signature Bank held a large portion of their assets in fixed income US Treasuries, also known as government bonds. And the problem is that interest rates and fixed income government bonds have an inverse relationship, meaning that as interest rates rise, the value of government bonds decreases. This is because if the baseline interest rate rises, then the yield that you will get by storing your money in a bank does rise as well, and therefore the bond market naturally needs to correct to reach a point where government bonds return a higher yield. The only way for yields to rise on fixed income government bonds is for the asset price to decline, and so through this period that we've seen recently of rapid interest rate hikes, we have seen the value of government bonds fall quite rapidly to reflect a comparable yield for investors. Many other banks are in a similar situation to the banks that collapsed last month, in the sense that they hold a large portion of their total assets in government bonds and are therefore sitting on large paper losses right now. It only takes one look at the performance of TLT, an ETF tracking the value of 20-year Treasury bonds, to see just how underwater banks may well be on their holdings of these bonds. Now, the asset value of this ETF is down approximately 35% from the peak that we saw in 2020, and in fact, you'd have to go back as far as 2013 to reach a point where the value of government bonds were this low. When there is a large outflow of cash from banks who have large US Treasury holdings, then they are forced to sell these US Treasuries at a loss in order to generate the cash that they need to pay out on these customer withdrawals. Now, this can cause a chain of events leading to a panic and bank runs, which means that we could see more banks get pushed over the edge and completely collapse in the future. Dimon also criticised the stress testing that is done by the Fed, claiming that it is too academic to prevent bank runs, saying a less academic, more collaborative reflection of possible risks that a bank faces would be better to inform institutions and their regulators about the full landscape of potential risks. Dimon believes that the only unknown risk at SVB was the lender's concentrated base of corporate depositors, which he says was controlled by a small number of venture capitalists who all moved their deposits at the same time. He also thinks that although the problems that banks are experiencing right now are not as bad as those seen during the 2008 global financial crisis, he did warn that there is still potentially trouble brewing if the Fed are too aggressive with their monetary tightening. Now, Dimon did also warn that shrinking consumer savings and rising consumer debt is a growing problem for the economy. Now, consumers have been spending between 7 and 9% more compared to last year and 23% more than pre-pandemic. Now, this is also reflected in the sharp decline in the amount of money that US citizens have in savings right now, which is now at $915 billion. This is down over 60% from just 2 years ago in February of 2021, meaning that consumers have depleted their savings rapidly over the last couple of years. Now, granted, a lot of this money was pent-up savings from the pandemic, with government stimulus checks added on top of this. However, if we compare this current savings figure with the $1.38 trillion in savings that consumers had at the end of 2019, then savings are still down by over 33% compared to pre-pandemic. High inflation, rising housing costs, and higher bills have all contributed towards this higher spending, while at the same time, salaries have not risen in line with the rising cost of living, despite unemployment still being relatively low. But a higher cost of living is not the only thing that is leading to lower consumer saving, and looking at the personal saving rate, which calculates the percentage of disposable income that consumers save on average, we can see that we are also at levels that are very low compared to this historical average. The key with this metric is that it excludes personal outlays for any sort of cost of living outgoings and just focuses on disposable income. Now, consumers are saving just 4.6% of their disposable income right now, which is far lower than 2 years ago and close to half of what they were saving at the end of 2019. Now, this once again shows that consumers are saving far less than pre-pandemic, and although the cost of living crisis means that there is less disposable income to spend, it does also suggest that consumers are simply choosing to spend more lavishly nowadays rather than saving. And in synergy with consumers spending more and saving less, credit card debt is also rising, with many consumers relying on credit card debt to continue funding their lifestyle despite maybe not actually having the money available to them at that moment to afford it. We saw US consumer credit card debt spike by 7% in Q4 of 2022, and it hit a new all-time high of $986 billion, meaning that when the numbers come out for Q1 of 2023, we're almost certainly going to be over the $1 trillion threshold for consumer credit card debt. And credit card debt is not the only type of debt that has been rising rapidly since the pandemic, and in fact auto loan debt, student loan debt and all other types of debt have also been rising too, taking total consumer non-housing debt to a whopping $4.64 trillion. Now, all of this consumer spending behaviour does point to big trouble in the future. Now, consumer spending may be strong right now, which is propping up the economy, but it just isn't sustainable in the long term. Savings are being depleted and not being added to, and this means that many consumers are running out of cash and resorting to credit cards to keep up their previous spending habits, in turn racking up high interest credit card debt. When this bubble ultimately pops, we're going to see a sharp drop-off in consumer spending, which will harm the overall economy massively. Businesses will obviously be hurt financially from this, and we could see a rise in layoffs happen as businesses fight to cut their costs. Now, due to the nature of Jamie Dimon's position as CEO of the largest global bank, or at least the largest in the US, he simply cannot come out publicly with a completely negative letter, which is why his recent letter to shareholders did include a number of positive statements as well about the economy. For example, Dimon did state that we are not facing a crisis like what happened in 2008, and for the most part he is probably correct about this. However, there are some clear warnings being issued here from Dimon in a way that is subtle enough to not cause mass panic and bank runs across the US, because after all, JPMorgan is a bank and would not necessarily benefit from this happening. So we know the banking sector is facing some potential problems in the future which could have further knock-on effects on the economy, but the housing market is also in a worrying position right now in which we could see some major corrections in many regions of the US. If you want to see the top 10 cities at risk of suffering from a housing market crash in 2023, then check out my recent video on screen right now. Aside from that, please leave a like on the video if you enjoyed it, subscribe if you want to see more, and thanks a lot for watching.